dropped off to 1 to 3%, depending on where you go, and in some parts of the US have actually turned negative. Derivatives, they didn't exist back in the 70s, not to the extent they do now. And derivatives are simply a side bet. I want to buy an IBM stock, but I don't want to impact the stock. So I go to, back in the 20s, we called them bucket shops, but in the 70s, they didn't exist. I couldn't make these side bets. Well, in the era of Clinton's administration in the US as a president, he revamped that regulation and he allowed people to reinvest. So we went from having 30 years, 40 years ago, very little or no derivatives or side bets, if you will, on what the economy will do or what stocks will do, all the way to 2012. And in fact, what we have today is something that's running wild. It is absolute hidden ticking time bomb. Over $600 trillion in bets. $600 trillion. You can't even quantify it in your head, but it is a ticking time bomb waiting to happen because it is highly leveraged and it could blow up any minute. Now, foreign investment back in the 70s, it wasn't enormous. We didn't have investors from all around the world looking to the US to invest, to take their debt. Treasuries weren't being sold at the pace they're being sold at now, and they weren't printing the kind of money they printed today. By the end of the 70s, that changed, but at the beginning of the 70s, that didn't happen, and foreign investment just wasn't, it was minimal. Now, the US back then, again, was not dependent on foreign oil. Now, that's a huge point because every president since Nixon has tried to convey in his platform that they are going to get rid of foreign oil dependency. Now, foreign oil dependency has impacted gold greatly. It's impacted every market around the world. And of the things we're going to discuss tonight, it is a very big part of what has transformed the world economy. Now, if we go a step further, in the 70s, US dollars were not all over the world. We didn't have a lot of circulated fiat physical dollars circulating around the world. Back then, it was predominantly in the homeland. It was predominantly in North America, very close, with the exception of a few other places. But we didn't have a lot of US dollars as opposed to today. It's the reserve currency. There are more US dollars in the world than ever. We'll get into that down the road, but the point is that when you see such a change in 40 years, it can only result in having things like gold and silver go much higher because of it. Now, what's happened today, what we've seen is, we've seen record-topping trade deficits. Around the world, every country has to import and export. It's more interconnected than it's ever been. And the US is right at the top of that. Every month we get the statistics, and every month $40 to $60 billion in additional deficit debt is added to the overall debt of the US. Every month, and it's been that way since I've been at the firm. The reality is that we're adding more and more of it as we go along. And this, again, it combines as part of the reasons why I would want to own assets like silver and gold. The Eurozone. Well, of course, everybody knows the Eurozone. They know their problems. They know that, sooner or later, one or more of the countries in the Eurozone are going to want to leave. They're not going to tolerate the amount of debt being created. They're not going to tolerate the outcome because they're all in it together and they don't want to be. The Eurozone was a bad idea to begin with. It's a bad idea now, and inevitably down the road, it will end, in my opinion. We did not have the euro either, and the euro, unfortunately, is not very strong at this point in time, and going forward, it could fall apart in a very short period of time. We'll have to see. We didn't have domestic terrorism. Again, the thought of domestic terrorism was absolutely foreign to us. After 9/11, of course, now this is thought around the world as something that we have to live with every day. But in the 70s, there was no such thing as domestic terrorism. It just didn't exist. You had a lack of misleading financial statements back then versus now. I have to double check everything that I read, every headline that I look at. And if you don't, you should. Every statement that gets sent home by your financial banks, your financial planners, everything, you should look at. You should know where your money is. And again, in this day and age, we are having more than ever misleading information. And that's not only from financial statements, that's from the week-to-week job reports, the housing starts. They all get readjusted And this all adds to this great big impression that we get from time to time about what the economy worldwide is actually telling us. Well, it's not in good shape. And it hasn't been in good shape for a long time. We've just simply failed to see that. Now, if you look at today, what didn't exist in the 70s, and remember, silver went from $1.55 to $52 an ounce, 3,200% gain. 26% of the population participated, of investors worldwide, and it did not include 1.6 billion potential Chinese investors. That is an incredible statistic looking forward. If you know nothing else about China, they preach the ownership of hard assets. They do not like their citizens to own debt. They are against the idea of depreciable debt or credit cards. They tell their citizens to buy gold and silver. And if you go to China, I don't know how many people have been to China, you will see that it is very common to find bullion firms that are selling the physical product all over the place. It is very common to see machines dispensing gold coins, gold bars. It happens because they have the foresight. They understand what is happening. They have seen the West create the problems, create the debt, and now they're telling their citizens how to avoid it. And of course, now the US dollar is the most widely circulated currency in the world. And again, if you look around the world, too many people have relied on that US dollar. And I'll get into it in a minute, but the reality is that going forward, we are about to see a huge change. And that could result in the loss of the US dollar being the reserve currency. And of course, that's not something that I'm prepared to talk about tonight. It's a whole can of worms, but suffice it to say, it has a major impact on gold and silver prices. Now again, let me remind you, there are 4 points that we're talking about, 4 fundamentals that I want to make sure that you know before you go here tonight. There's global currency devaluation happening. Countries are competing to keep their currencies in check by printing more and more and more. The more I print, the more I keep the currency in check. It's losing value, but I'm willing to live with that because eventually I have to pay my debts. The only way to do it, devalue the currency, take it down in value. You have inflation. We're going to get into that in a minute. It's an important point. You have geopolitical unrest. Countries are buying gold around the world. Central banks are buying gold. And they're doing so at an accelerated rate because they understand the value of doing that, protecting it, ensuring their current investment. Now, if you look at global currency devaluation, as I said, this is just a race to the bottom. I'll put up 3 points here that I'm going to make. I'll let you read them as we're talking, but the idea here is very simple. Money is being printed all over the world. It's being printed at an accelerated rate. We are seeing faster than any other time in history fiat currency coming to the world economy. But you and I are not seeing it. We're not seeing it at the entrepreneurial level. We're not seeing it at the building block level, at the infrastructure level. It's still tied up in our institutions. They're liquid, they have cash on hand, and whether or not they're going to use it remains to be seen. But for the purposes of protecting their investments, they're holding on to it. The Federal Reserve in the US has printed money hand over fist. The printing machines have been running wild. The whole time that they have been doing this in the US, all the other big G20 nations have also been doing it. We're doing it right here. It's just when the US does it, they get more coverage. Now, if you look at that chart, what that's showing is the loss of purchasing power over a period of time of the US dollar. That stems from 1913, the year the Federal Reserve was created, all the way up to 2010. And what it shows us is that the US dollar, as a global currency around the world in terms of a basket of goods that it could have bought in 1913, can now buy 95% less than it did back then. So you ask me whether or not the US dollar is devaluating, that proves it. It certainly is. And as a result, countries around the world that are seeing that happen are buying gold, buying silver to protect themselves because they hold US dollars. Now, if we look to inflation, it's a completely different point, but precious metals typically are an excellent hedge against inflation. They have traditionally performed extremely well when inflation has risen. Now, some of you may have, and I'm not trying to age anybody, but some of you may have remembered the 70s and the time when we had double-digit interest rates. Our savings accounts made money, but at the same time, our mortgage rates were also 12, 16, 18, and even 20+%. Those were periods of high inflation, and they impacted the prices of gold and silver in the 70s dramatically. Remember, gold jumped 2,300% in 10 years. Silver jumped 3,200%. So if we look at the printing presses, inflation is something we can't necessarily see. It's happening right now. I can assure you it's happening. Every day we are losing more and more of our purchasing power. We are able to buy far less than we did the year before, and it's getting worse. Now, this is a quote by Alan Greenspan. He's the former Fed chairman before Bernanke, and what he said was, essentially, inflation is a way to confiscate one's wealth. If I let inflation occur in my economy, I'm going to confiscate the largest class of citizens, the middle class, their wealth, because their purchasing power is going to decrease. Traditionally, gold and silver have been able to provide a sturdy base against depreciation, from which you have gained value in the long term and protected your purchasing power. And even Alan Greenspan, who started this whole fiasco when he started printing money, even he said that gold and by extension silver are one of the only two assets in the world which can protect you when inflation occurs. So what we want to do is we want to look at inflation. And again, I want to remind you that if you have too many dollars, and I'm printing dollars left and right, I'm the Federal Reserve in the US, and I've printed a ton of money in the last 10 years. And if I have too many dollars chasing the same amount or less goods and services, I have inflation. It means that my purchasing power is being eroded. And what I want to, again, remind you is that during periods of time in which inflation has been high, we've seen silver take off rampantly. It's accelerated, in fact, and the 70s was the last time. Now, if we look at currency and what's being printed, it's so important to remember that we are seeing the fastest amount of money being printed in the shortest amount of time in history. It took almost 160 years to create $800 billion worth of fiat currency floating around the world, US dollars, 160 years. So we are looking at something, and we are absolutely realizing now that it took very long period of time to create a lot of dollars. Since 2008, the Bush and Obama administration have tripled it. 160 years to put $800 billion into the marketplace. It took less than 4 years to triple it. $2.4 trillion floating out there. It is a horrid reality to have to accept, but one which gold and silver respond to very, very well. So I'll quickly run through this because I said earlier, it's hard to picture what trillions of dollars is. Here on the screen is a $100 bill, and everybody can picture that. They know what it is. There I'm showing $10,000. And again, we could all think what I could do with $10,000. Now we go to $1 million. And $1 million is a lot of money. You could do a lot of things with $1 million, but I can still think in my head what that means. Now if I move to $1 billion, it starts to get a little bit foggy. There's two people to help you, show you how much money that is. And when I move to $1 trillion, what you don't see way up in the left corner there is a football field with an airplane, in fact, a jumbo jet airliner, and the White House. And in front of that, all those pellets, all those piles are money. That's $1 trillion. The US has $16.4 trillion worth of debt. Now, if you don't think that the US dollar is going to continue to devaluate because of that debt, this is probably not the right place for you guys to be. Because I can tell you the reality is it will continue to devaluate. And as it does, gold and silver prices will rise because of it. Now, over the next 10 years, what we think is going to happen is hyperinflation. The amount of money that's being printed in such a condensed period of time is going to result in hyperinflation. And that could in fact, really gut us as an economy. We have to look out for it, we have to be cautious, but we have to be prudent in knowing that we took the right steps to protect our family, our wealth, and our well-being before it happened. And that's as a result of the amount of money that's being printed. So if we look at geopolitical instability, I won't spend a lot of time on this. Suffice to say there are 3 points that I want to make. When you look at geopolitical hotspots around the world and reasons why whole countries own gold and silver, they do so because of the uncertainty of the region they're in, the uncertainty of the global economy, or perhaps they do it because of what they expect might happen. I'm sure people have heard about sovereign debt. It's all around us. The Eurozone is something that talks on a daily basis about sovereign debt. You have the Middle East, you have Israel, North Korea, you have the Strait of Hormuz, which is a major shipping lane for oil, all at risk because of geopolitical instability. And the reality is, you have to be careful because countries are doing it. They're ahead of us. And again, since 2007, central banks have been net buyers. So let's look at the most important point quickly. We have over on the right-hand side a Canadian silver maple leaf. And on the right-hand side, you have a whole bunch of people who want that one Canadian maple silver leaf. Now, in 1980, when the price of silver rose all the way to $52 an ounce, you had above-ground supply of about 1.6 billion ounces. It was a lot of product. It was something that the world had enough of at that time. It wasn't like we had a shortfall of it. But if I fast forward to 2012, that's dropped, not expanded, from 1.6 billion down to about 900 million, of which half of that above ground supply of silver is spoken for. It's gone. We can't have it. We can't touch it. We'll never get our hands on it. So the reality is that in this day and age, we are looking at a marketplace which has approximately 400 million ounces, and there's nothing we can do about that. We're not bringing more product out of the mines. It is a byproduct of copper mining, gold mining, zinc mining, and lead mining. 80% of it coming to market. That's the way we get our silver. And you can see since 1990 that, in fact, it has dropped way off. In 2011, we had 1.1 million ounces of silver made out of the ground, mined. And if we look at the demand picture, we're experiencing the highest demand in history against a backdrop of the lowest supply. Now, if I look at demand, it's the important part